My name is Peter Coy. I'm the president of the New York Financial Writers Association. I want to welcome you to this evening's Zoom session on the Federal Reserve. And before we start, I want to express my and the organization's sympathy for the loss of lives in the Texas elementary school shooting. The New York Financial Writers Association is an organization that dates back to 1938. Many of you are familiar with it because we put on a lot of events such as this one. We've had an extremely busy year in 2022. Just very quickly to run through some of the things we've done. We had a webinar on our own organization's Impact Award winner, a webinar on how to write about personal finance, reporting the financial fallout of the Ukraine war, pioneering women in financial news and their heirs, the Elliott Bell Award honoring Andy Serwer, and just this past weekend, the Financial Follies, which was a big success. Now this event, and then in June, we have an event on cryptocurrency. We have more events scheduled for the fall. So we're really hitting on all cylinders. And tonight's event is going to be really good. I'm going to turn it over now to the organizer of the event, John Biers, who will introduce the panelists and explain this evening's format. And with that, I'll take myself off camera.
Hello, I'm John Biers. I'm the business correspondent for Agence France-Presse in New York. I'm glad to be here tonight. I want to second Peter's remarks about the Texas tragedy. It's really horrible to see. When we started talking about this panel a couple months ago, this was an idea that I got to do a panel after seeing a review of Chris Leonard's book on the Fed. And it was called, in the New York Times, called it a fascinating page turner about the Federal Reserve, which I thought was kind of an interesting and surprising way of thinking about the Federal Reserve, which I don't think of as being something that lends itself to being something quite that dramatic for the general reader. But I was intrigued by it and also really wanted to, thought it could be a good panel, but thought the book, when I read about it, sounded pretty harsh in terms of the way it appraised the Fed's performance over this past year. So I wanted to have a bit of a balance on the panel. So before I introduce the panelists in a moment, I'll just lay out the plan for tonight. We'll talk for a little while. The book is about looking at quantitative easing and kind of a critique of the Fed's policy since 2008. When we started doing the panel, it was really before this last debate shifted so dramatically to being one about inflation. So what we're going to do is talk first about quantitative easing and about the actual arguments in the book, which is here. It is a really good book. Recommend it. And then we'll talk about inflation, and then I'll take some questions from the audience. And then if we still have time, I'll have some additional questions. So I'm going to introduce the panelists now. So we have Chris Leonard here, who is the author of the Lords of Easy Finance, Lords of Easy Money, sorry. And Chris is the author also of Cokeland and the book, The Meat Racket, and he runs the Watchdog Writers Group at the University of Missouri's School of Journalism. So welcome to Chris. Our second panelist is Peter Conti-Brown. He is a professor at the Wharton School and also a fellow at the Brookings Institution. And he is the author of another very fine book about the Federal Reserve called The Power and Independence of the Federal Reserve. And Peter's background is really writing about, he's a financial historian and legal scholar and expert kind of on financial regulation. So those are our two panelists. And so I'm gonna just go right in with a question for Chris first, and then we'll have a bit of back and forth. But Chris, so the name of the book is The Lords of Easy Money, How the Federal Reserve Broke the American Economy. So maybe you can explain to us particularly the second part of that title, the how the Federal Reserve broke the American economy. Is the American economy broken, and did the Federal Reserve break it?
Yeah, thank you so much. I really appreciate that, and thank you for having me. Also, I triple the comments. What a sad night. One of the background issues of my book is the sort of collapse of the ability of our democratic institutions like Congress to tackle big problems, and that is a fact that keeps staring us in the face with these horrific mass shootings. So I don't want to say thoughts and prayers, but this stuff is definitely on all of our minds tonight. So with the subtitle of the book, what I was really going for here was subtlety and nuance, with my subtitle, How the Federal Reserve Broke the American Economy. And obviously I'm joking, and I'll be totally honest, a subtitle like that is not in my comfort zone. And the previous subtitles of my books talk about secret histories or profiles. I really came to this conclusion through the reporting for the book, and I'll walk through that a little bit. This book for me started in one place and ended in an entirely different one. And I would argue, yes, absolutely, the American economy is broken today, and the Fed has played a critical role in doing that. And I really need to own that subtitle. And I guess I'll start by saying the Fed has done three key things that I think have broken our economy. The first is it has dramatically intensified income inequality over the last decade. We will talk about that. Secondly, the Fed has incentivized a massive run-up in risky debt in corporations, in the government sector, in households. It has cheapened debt and created a massive upswell in debt. And then thirdly, it is really increased fragility in our financial markets. It has elevated asset prices to levels that can't be supported. It has increased investment in risky instruments like collateralized loan obligations, like leveraged loans. I walk through all this stuff in my book. And, I think we're paying the price for that today. And I know we're going to talk a lot about this, but the Fed is really in a hard spot of its own creation. The Fed is being forced to tighten the money supply, to raise rates, to pull back on quantitative easing, to fight inflation. But in doing so, it really risks creating another financial market collapse. And that is something the Fed did through this previous decade of policy. So that's why I said what I said. I'm of course going to walk through all this in more detail. But I suppose this would be my chance to sort of quickly lay out what's in the book. By the way, I'm jealous of your hardback copy of Peter's book. I have the paperback. It's a fantastic book and strongly recommend it. My book is a little bit different. It's a reported history of a decade of Fed policy. It really starts in 2010 and ends in early 2021. So it's 10 years of Fed policy. And the reason I was drawn to this topic was I came to understand that what the Fed has been doing since 2010 is unprecedented. I would use the word radical and certainly experimental. We could call these policies what they're referred to in shorthand as ZIRP, zero interest rate policy. It was this decision, this policy decision made inside the Fed to pin the short-term interest rates or the Fed funds rate at zero for 7 years between 2008 and 2015, while at the same time accelerating money creation at just a stunning rate. Probably the most famous graph, I think, that gets passed around about the Fed is the graph that traces the size of its balance sheet, which of course reflects how much money the Fed has been creating through that policy you mentioned of quantitative easing. And it's just a stunning chart. I mean, you see the slow growth for about 100 years in the balance sheet, a slow and steady growth up to about $900 billion in 2008. And then between 2008 and early 2015, the Fed expands its balance sheet by 3.5 trillion. through quantitative easing. And I wanted to walk through the mechanics of what quantitative easing is. It's the creation of new dollars on Wall Street inside the reserve accounts of the 24 primary dealers. It is injecting new money into the banking system to try and stimulate economic growth. It's basically a jobs program. That's what makes it so different in my mind from previous eras of monetary policy. The Fed did this starting, really, we know they did a round of QE in 2008 during the crisis, but the real history in my mind starts in November, early November 2010, when the Fed decides to pursue quantitative easing to stimulate economic growth, not to bail us out of a four-alarm fire, but to stimulate economic growth. That's when we see the Fed print, at that point, 2.5 trillion more dollars and injected into Wall Street. And it had this very particular effect, keeping interest rates at zero and pumping all this money into the banking system, created a massive, what we search for yield, a pressure on big institutional investors to push their money out into riskier and riskier parts of the financial economy, moving out on the risk spectrum, buying, inflating asset prices for tech stocks, commercial real estate, all these instruments that I talk about in the book. This helps explain why we saw this decade where productivity growth was weak, wage growth was essentially stagnant, if not actually shrinking for a decade. Economic growth was weak, but the market for assets were just on fire. The stock market doubled. You saw a huge run up in the corporate bond market. Quantitative easing, 0% interest rates, helps describe why that happened over the last 10 years. And so I don't want to filibuster here, but that's what my book is about, okay? It's the history of why the Fed did that, the internal debates. This was very controversial policy within the Fed. And then I try to walk through the real world effects of this, which I argue have been terribly negative. We achieved very small gains while building long-term risks.
Okay, I want to let Peter talk a little bit about, maybe you could comment a little bit about those arguments and how you see, obviously rebut that, but also, maybe talk about the ways you think the Fed's policy was more beneficial on the economy.
You bet. It's such a pleasure to be here, and thank you to all of you for the invitation, for the chance to comment on Chris's book. He and I had a chance to talk when he was reporting an article for Time Magazine, if I recall correctly, about some of these issues. And a lot of my thinking at the time is that I told Chris, just as a source for him, it hasn't evolved too much. And I want to explain why. I think that Chris has done something extremely important with this book, which has taken a major figure, I think of as an extremely gifted politician, it's just Thomas Honig, and given voice through extensive interviews and using Honig as a primary source to articulate the political project that Honig undertook in the 2010s, which created some real instability around the Fed and brought some ideological and intellectual diversity to some of the discussions around quantitative easing. And I think that's an important voice, because many people think, oh, the Fed is the institutional shadow of a single individual, like the Fed chair. So this was the Bernanke Fed or the Yellen Fed. But in fact, that's not even close to being true. The Fed is a complex institution. It consists of interlocking committees, and the individuals on those committees, including as they go on CNBC and comment to journalists and build political coalitions, are creating a vibrant, controversial, and important, both technocratic, but also very political conversation. And I would say that I don't know of a politician who was more able, central banker who was more able than Thomas Honig. I'm in a kind of a funny position. I've never worked at the Fed. I don't ever intend to work at the Fed. My book is in fact pretty critical of the Fed. I did a panel in 2015, right as my book was coming out, with some Fed officials, and some journalists snapped some photos of them looking extremely grumpy while I was holding forth in a critical tenor So I'm not here to defend the Fed. Let us be extremely clear about its role in exacerbating, responding to sometimes too quickly, sometimes too slowly. But I do want to provide a little bit of a different perspective on the attribution in Chris's book, and especially by Thomas Honig, of the Fed as the power that can dictate these secular trends that pre-exist the 2010s by many decades, and to which the Fed, like so many of us, may in fact just be a player on the stage as opposed to its playwright. There's a famous axiom from the former Speaker of the House, Thomas Brackett Reed, who says, one of the greatest delusions in the world is the hope that the evils of the world can be cured by legislation. That's a pretty cynical view. I think legislation can do a lot. But what I read in Thomas Honig's articulation of laying at the feet of the Fed the ills of wealth and income inequality, the ills of concentration in the banking sector, the ills of inflation that he all but guaranteed would come in the 2010s, which did not come. And the inflation that we're seeing today, I think, is a wild stretch to attribute to quantitative easing of the 2010s. I think that is giving too much credit to an institution that is as bewildered as the rest of us about these long-term secular trends, and too little credit to to these very trends themselves, including through our political institutions. Now, Tom Honig would bristle at my characterization of him as a politician, but I don't think he should. I think he's an explicitly political figure. One part of his history that isn't covered in the book is he was one of the most effective lobbyists during the debates around Dodd-Frank to protect the Federal Reserve banks and their curious prerogatives in bank regulation and supervision. After Chris Dodd and Barack Obama and Ben Bernanke struck a deal that said the fragmented institutional incoherence of our bank regulatory and supervisory system that allows these big banks to gain advantage by pitting the FDIC off of the control of the currency, off of the Federal Reserve. The very fact that the Fed seemed to have failed so spectacularly at its bank regulatory and supervisory mandates meant that we needed to take that authority away from the Fed. Now, originally, Chris Dodd wanted to take all of that away. Barack Obama, after Ben Bernanke, himself a politician, central banker, lobbied for the restoration at the highest level. The largest banks had to be regulated by the Fed. They couldn't have an opportunity to escape that regulatory and supervisory scrutiny. And then the bill that was passed in the Senate took all the rest and gave it away from the Federal Reserve. And then Tom Honig arrived on Capitol Hill. And we've got some good press coverage on this. I've spoken to him myself personally about this. He said, I wasn't a lobbyist, I was an educator. And I wanted to go to and I walked the carpets bare, telling every senator that the Federal Reserve banks needed to keep their regulatory and supervisory authority. And he was so effective that the amendment to restore the Federal Reserve Bank's supervisory authority to keep that regulatory system splintered passed 91-4. It's the Klobuchar-Hutchinson amendment. And if you think Amy Klobuchar and Kayleigh Bay Hutchinson didn't have a lot in common, you've got a good sense of how effective Tom Honig was as a politician. Tom Honig was obsessed with inflation during the 2010s. Chris characterizes this differently in the book, but I don't think that's fair to Tom. Tom was obsessed with inflation because he came of age during the 1970s. He overlearned its lessons. He had on his wall, it was Chris documents, notes from the Weimar Republic. And in his speeches and in his press and in these FOMC transcripts, he is talking insistently that we are running an experiment that will be inflationary in nature, that we will not be able to exit, and the failure to exit will be inflationary. And I think that these hawks of the 2010s, which created this enthusiasm for the idea that the Fed's actions were inherently inflationary, they deserve to be told that they were wrong. Now, the inflation in the 2020s we'll talk about, that's quite different. And I think that is a really important conversation for us to have. I hope we have it. But here's where Tom Honig, I think, has some real power. And Chris does this documents this extremely well. And that is, he's not only obsessed with inflation. And here he parts company with some of the other hawks, kind of traditional hawks. And I think Tom Honig is a traditional hawk, except here. And that is his critique of concentration in the banking sector. And here, because later he becomes more focused on the consequences for not income inequality, but wealth inequality. I think the income inequality argument is extremely difficult to sustain for reasons that we can get into. Wealth inequality is easier for the reasons that Chris mentioned. At the very least, wealth inequality and exacerbation of wealth inequality was exacerbated during the period of balance sheet extension. And Honig's focus on the problems of wealth inequality and the problems of bank conversation, Republican though he was, conservative though he was, inflationary hawk though he was, give him a voice on what I've called the hawkish left. And I think the most important achievement that Chris has given us in Lords of Easy Money is he joins a couple of other books for in planting a flag for the hawkish left. Now, what I mean by that is these are hawks. They want interest rates higher than they were. They do not want a monetary accommodation. This is historically something that those on the left representing labor unions and working families and those who are interested in seeing more monetary accommodation for an ailing economy. That's not their appetite, but their appetite is on behalf of, or ostensibly on behalf of the interests of those individuals and institutions, because they argue that the moves in order to accommodate the economy through the levers of monetary policy are in fact destabilizing for the interests of working families, labor unions, and those who the economy very often leaves behind. This is a new phenomenon. It's relatively rare that we see a scrambling of political coalitions around money. The old endurable traditions of populism, of Jefferson versus Hamilton, of William Jennings Bryan versus William McKinley, of those who would favor a gold standard versus those who would favor something else. Those have been durable throughout US history, and we're seeing a fissure now. And I think Chris is at the vanguard of articulating that view. Thomas Honig is its prophet and its chief politician in many respects. His is a voice that needs to be taken seriously. But even though I am a Fed critic in many respects, I'm the furthest thing from a Fed insider, I don't think that either Chris's subtitle or Tom Honig's prophecies should be given much heed. I think they have virtually nothing to do with the Fed's current catch up with policy that we're encountering in the 2020s. And I think every prediction that they made either turned out to be completely false. The inflationary predictions of the 2010s simply did not materialize. The Fed had the opposite problem. Or they've engaged in a kind of lazy empiricism where they see a correlation whose origins extend far into the decades in the post-war era and say, because of the correlation, the Fed was engaged in quantitative easing, we have wealth inequality problems, that they assign that causal relationship without that causal demonstration. There's nothing in Chris's book, and there's nothing in Tom Honig's speeches, and there's nothing in the FOMC transcripts that demonstrate that causal mechanism. We have merely a correlation. And I think that's a pretty flimsy basis on which to try to, to say that the institution itself has created all that ails us. So let me stop there and continue to engage, and we can come back to what I think are the other major issues with the hawkish left.
Peter, let me just, before I maybe just real brief. So there were two parts to the subtitle. There's how the Federal Reserve broke it's basically how the Federal Reserve broke the American economy. So you don't think the Federal Reserve broke the American economy. But I just have a question. Do you think the American economy is broken? How do you see these issues right now?
I don't think that the American economy has ever been whole and hale, at least not for everyone. Indeed, one of the parts that I found so hard to sustain in the praise for Thomas Honig is he's quick to dismiss an unemployment rate at 9% and does not grapple with the fact that unemployment rate for African Americans, for immigrants, for single mothers was so much higher and falling in a period of monetary accommodation. And so is the American economy doing everything for everyone? Absolutely not. In that sense, is it broken? You bet. Did the Fed break it? Not even close. I think that the Fed is not the hero of this story, but nor is it its villain. I think the Fed has a relatively limited, very important role to play. And I think the over-attribution to this power at the Fed, it can delegitimize the institution, and it can also distract us from understanding better what is the policy problem that we're encountering and what are the right solutions.
Okay, I want to give Chris, do you maybe want to briefly respond to?
I don't want to briefly respond. I'd like to fully respond, if that's okay. I mean, that was quite the soliloquy. I try not to filibuster, and then, you know, I would have had a much longer intro statement. So I loved that. Thank you, Peter. That was fascinating. Okay, let me go back to a couple points here. If Thomas Honig was such a gifted politician, why did he lose virtually every policy fight he ever waged at the Federal Reserve? I mean, this book starts in the year 2010 when Thomas Honig dissented at every single meeting of the FOMC. He voted no, 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 8 times in a row. The votes were, I think, entirely 11 against 1. So this sort of like magnum political lobbyist figure, it doesn't like conform with what I saw. I came across Honig when I was starting to report on quantitative easing, particularly the first big round, QE2, or the first jobs program type QE that existed in 2010. He was the only guy that voted against it. And in fact, he really, it cost his career, that string of dissents. He was sort of drummed out of the respectable circles of Federal Reserve officials. And he had not been much of a dissenter up until that point. He largely voted in line with the Fed until 2010. Now, if there's one thing I can just categorically and cheerfully disagree with entirely, it's your assessment of what Honig's dispute was in 2010. He was not obsessed with inflation. This was one of the biggest things that I discovered going back and looking through the actual record, looking through those FOMC debates in 2010, looking through the interviews Honig gave, looking at the comments he gave, the famous speech he gave at KU in 2010, where he called quantitative easing a deal with the devil that so agitated Ben Bernanke. The interview he gave with the Wall Street Journal Saturday Review, he was talking that entire time about 3 critical things. The first was the misallocation of resources that was going to occur through these policies, which was pushing money toward riskier investments while benefiting the richest of the rich and stoking income inequality. We can call that the misallocation of resources. The second key thing he warned about was the quagmire that was going to be created by these policies. He talked about this again and again, that once the Fed started going down this path, it was never going to be able to pull out. Once they started doing quantitative easing, they weren't going to be able to reverse that without creating economic calamity. And they were going to be stuck in this program. And then the third thing he talked about was this issue of financial market instability, creating asset bubbles, which, your point about the bank supervision issue was right on point and fascinating. Honig had spent his entire career inside the Fed, and a huge part of that was as a bank supervisor and a bank regulator. And he saw the distortions that devastated the banking system in the early 80s after the inflation of the 70s. I don't think he overlearned anything from that. He saw through firsthand experience what happens when the Fed keeps interest rates too low for too long. All of those predictions are absolutely true. I mean, I walk through all of them in the book, and I think it almost understates what a terrible place we're in right now because of these Fed policies. Now, I want to jump ahead to 2 things, and this is one I really want to talk about. You're challenging this idea that quantitative easing stoked income inequality, that is directly responsible for elevating asset prices to levels that aren't supportable and that will cause it to collapse. In my mind, it's just not fair to say this is simply a correlation, because when you look back at what the Fed was talking about when they started doing quantitative easing, which, side note, a lot of my reporting came from talking to these people on Wall Street. We've got two different spheres of people who talk about the Fed. We've got the people in the economic circles, you know, and the academic circles. And then we've got the people who actually operate in the Fed's shadow and who trade and who make decisions based on what the Fed is doing. And those folks are entirely unsentimental in describing what the impacts have been. And it's not controversial that the Fed has been stoking massive asset bubbles. And there are really two main characters in the book. The first is Tom Honig. The second character is Jay Powell, okay? And we follow Jay Powell as he comes into the Fed in 2012 and enters as a really vociferous critic of these policies. And in 2012, Jay Powell says, like in the FOMC meeting, he says, I suspect the channels that we're using now, which primarily are asset prices, may not be working at all as well as our models say. He was not like disputing, nor was really anybody, that the Fed was pumping up asset prices. The Fed senior economist Bill English, and then I'm going to mispronounce this guy's name, but David Reifschneider. I mean, in the meetings, they're talking about the mechanisms through which this is going to work. Is it's going to make debt cheaper, it's going to stoke asset prices, and hopefully it'll help the exchange rate, which is basically like devaluing the dollar, maybe stimulating exports, okay? Asset prices were the key mechanism through which quantitative easing was going to work. They knew that. It's not controversial. They really need to own the elevated asset prices that existed when COVID hit in 2020 and that existed after the COVID bailout of 2020 that exists today. They elevated asset prices, and by definition, that widens income inequality because 1% of Americans own roughly 40% of the assets. The bottom half of Americans own 7% of the assets. So when you have an asset price first policy, you're widening income inequality. And so the reason that we're in this very fragile and to be honest, dangerous, broken place today in the markets is that the Fed is having to raise interest rates. They've risen them to they've hiked them to the sky high rate of 1%. They're talking about maybe getting to 3% next year, which, as you know, is historically low. And the S&P is already down 20% for the year. There's no reason in the world to believe that we're near the bottom, and that what's going to come next is going to be the correction in corporate debt markets, which is going to be way more significant. And so these are the problems that the Fed has been kicking down the road through this asset inflation policy, which is laid out totally clearly in the book. And it can be characterized however you want it to be characterized. I do feel like the primary contribution I made in this book was to report on the internal debates around quantitative easing inside the Fed between 2010 and 2020, and to report on the real world effects of it.
Peter, what do you say to that about the idea that this policy did cause asset bubbles? I mean, do you disagree with that?
I think that if Chris knew the fundamental value of these assets, he would be a billionaire and wouldn't be writing books like this. He'd be an incredibly successful Wall Street gambler. And Chris, you just described wealth inequality. You didn't describe income inequality. It's a very important difference. Even if you're saying that you're using a monetary policy, and you've shown, what you haven't, that it's causally responsible, that the counterfactual is established, that but for quantitative easing, these assets would be materially less valuable. That's wealth inequality. And the difference is not pedantic, it's extraordinarily important. Because the counterfactual is that there is some sort of neutral rate in the economy, and that the Fed should have its policy rate higher than that interest rate. That's the Tom Honig recommendation. That in facing a liquidity trap in the immediate aftermath of 2008, where real interest rates were deeply negative, that the Fed needed to increase interest rates and do nothing to flatten the yield curve, to do nothing to intervene on a longer part of the yield curve, which is exactly what Chris and many others call quantitative easing. That if they had done the Tom Honig move, that the jobs that individuals had because of companies being able to get access to credit to expand in a period of extraordinary economic devastation. That's the mechanism for providing those jobs, which is the mechanism for providing income. And when Jay Powell says, and I know exactly what you're talking about in terms of the critique, he's probably right. I don't think these are as effective as they would like to be. And the empirical research that has come out about quantitative easing says, you know what, we did an awful lot and it didn't have as big an impact as we hoped it would have. But that's an impact in either direction. And so calling it the bugaboo of income inequality is first just factually incorrect. You mean wealth inequality.
I do.
The wealth inequality is a totally different problem that requires us to say the economy has this neutral rate. The Fed is playing a game of darts with a blindfold on and is trying to peek out and say our policy rate needs to match this neutral rate. And what Chris and Tom Honig are saying and others in criticizing the Fed's policy is saying, I know that the interest rate, I know exactly where that neutral rate is. I know exactly what the consequences are. And we need to err on the side of increasing those interest rates to have less monetary accommodation, even though the economy is shouting out for it, because there are other kinds of consequences, whether for inflation, for asset allocation, for wealth inequality, what have you. And I think that takes a kind of level of prognostication and omniscience that no one in the Federal Reserve has. I don't think Chris has it. I'm certain that Tom Honig doesn't have it. And I think that's what overstates the argument.
Guys, I want to come back on some of these questions, but I do want to, since we're already a ways into this conversation, I do want to talk a little bit about inflation and the current debate that are kind of roiling the Fed. I guess I have one question from the audience that I'll throw in with this one. The question that sort of comes to mind right now is as obvious as like maybe you could tackle is to what extent did quantitative easing play a role in the current inflation? I mean, that is kind of play a role or not play a role. And that's one question. And then the other question that we got from Greg Miles, who's on the board, was wondering whether there were people inside the Fed that you understand kind of thought we're raising this risk, but we're not shunned it aside in this last period, or just what, you know, I know we're talking about Honig a little bit, but just I guess more recent than that even. How do you see these questions?
So I'll take the second question first. Even in 2010, when Honig was the only person voting against this, there was tremendous debate inside the Federal Reserve, inside the FOMC. All the names are in the book. You know, because of the quirks of how the voting happens, only a certain number of bank presidents can vote at a given time, whereas all the governors can vote. You know, one of the strongest opponents was the Fed governor, Kevin Warsh, who I don't think it's coincidental had come from the investment community, where the Fed's ability to inflate asset prices is not debated and totally well understood. It's just not useful, I think, to debate that the Fed stokes asset prices. And you're right, I'm sorry, the nomenclature was totally incorrect. These policies do dramatically exacerbate wealth inequality, which I think is terribly destructive to American society. Like mechanically, because of how it works, it drives up wealth inequality. So there was tremendous debate inside the Fed. And then in the later era of quantitative easing, you had Jay Powell forming a kind of partnership with Jeremy Stein, another governor, and Betsy Duke, who I quote at length in the book. Bernanke called them the Three Amigos. They raised a lot of very trenchant and correct opposition to quantitative easing in terms of the fact the Fed would not be able to pull out, that it was going to create deep risks in our financial system, which we are seeing becoming expressed today. And so the disputes inside the Fed have been strong around this, and it's just a matter of reporting. And you know, John Hilsenrath in the Wall Street Journal reported very well on how Ben Bernanke would lobby against the opponents of this. So, how did it play into inflation?
Yeah, consumer inflation, really not. I mean, asset prices are in a form of inflation. I agree, but this is really about consumer prices that I'm getting at, right? The current inflation.
So I think it's, you know, probably safe to say very little, in the sense that the consumer price inflation we see today is a collision of supply chain tension, a lack of supply, with very, very strong demand. That demand is being fed by, of course, the fiscal policies that put so much money into people's hands after COVID, which, you know, was in many ways a very largely necessary response to that crisis. And that strong demand colliding with the supply chain disruption. And so, to my mind, the danger is that the Fed has done exactly what Jay Powell warned, which is it did not give itself the tools to confront this problem today. That's why Powell wanted to raise rates and tighten in the 2010s, so that the Fed would have powder and ammunition to tackle inflation, which it does not have today. It does not have today.
Okay. Peter, what do you think about that question about I mean, actually, do you agree with Chris's assessment there that it's really not because of quantitative easing, although there was two parts to his answer. One was that it's not because of quantitative easing, but the quantitative easing makes the Fed's role harder now.
Yeah, I don't agree. I think here, actually, I'll say that quantitative easing is playing a bigger role than Chris thinks in this regard. But I'll do so with an extraordinary amount of modesty. The line between understanding where this inflationary burst is a consequence of a supply shock, disruptions in the supply chain, Russia and Ukraine, China shutting down once again, too many ocean freights stuck in Long Beach, versus the combination of monetary accommodation, including on the Fed's balance sheet, which went from about $3.5 trillion to $9 trillion over the course of 2020, which I take it to be, that's a little bit imprecise, but I think that's what Chris means is under the umbrella of quantitative easing. But of course, that includes a number of different moves that have nothing to do with large-scale asset purchases. That fuels a demand side. And when there's fiscal stimulus that has been so-called monetized because of the Fed's expanding monetary accommodation, then we have a demand side inflationary problem. And so the invitation for modesty that I would issue to myself and to all Fed watchers is to recognize that the appropriate fiscal or the appropriate economic policy response to inflation that is purely or primarily the function of a supply side disruption is fundamentally different from the policy response for demand side inflation. One of them travels right through the Federal Reserve and its policies, and the other does not. A supply side disruption has very little to do with the Fed, and demand side, of course, has an enormous amount to do with Fed. It's its narrowest responsibility. And so today, inflation, the task for the Federal Reserve is to discern through this noise the signal of where its accommodative monetary policies, accommodating fiscal expansion, is driving inflation, and to what extent, and to go there and no further. And that job is very challenging, but I don't think the Fed's quantitative easing either in the 2010s or in 2020 and 2021 is constraining on its ability to hear that signal. I think that signal is just enormously difficult to hear and discern in the best of times. Now, Jay Powell has admitted that he was wrong to say that we should lift off interest rates in 2015 through 2018. He regarded it as a major mistake for the Fed to do. And the reason is because with hindsight, we recognize that the neutral rate for the economy that the Fed has nothing to do with setting was lower than the Fed's monetary policy rate. And as a result, we saw real people, real families, real individuals who were cut off from the economic expansion in 2015 to 2018 because the Fed was too eager to raise interest rates too quickly. And if we lived in a world where Wall Street got to pressure the Federal Reserve to give it monetary stimulus so that it could make itself its billions, and the Fed could dictate that policy to us all, I would agree with Chris's quasi-apocalyptic view. I think that would be horrific, and it would speak to an extraordinarily broken economy and system. We don't live in that world because the Fed does not have that power. It just doesn't have that ability to dictate those kinds of policies. And my fear in reading Chris's book and the celebration of those views, which I think were proved wrong. And by the way, Chris, I love how cheerful you are in the rejection. I've read every single one of those transcripts. I went back to them again after reading your book, and we have a fundamental factual disagreement. about Honig's focus on inflation. He characterized his inflationary focus in a variety of different ways, but they all, with the single exception of the political risks of bank concentration, came back to this point. Even when he was talking about allocation problems, this is about inflation. He was talking about debt hangover, this is about inflation. He was talking about the inability for the Fed to exit the strategy, this is about inflation. And then he concretely used the I word in describing what he was nervous about with quantitative easing. And this is all there. So I think we do have a fundamental factual disagreement there. I think that would be the one that we're likeliest to resolve.
That's right. We have a fundamental factual disagreement, and I'm just going to sleep like a baby tonight in terms of what the historical record shows in this regard. Read the Saturday interview he gave with, I think her name is Marianne O'Grady in the Wall Street Journal in 2010. I mean, this is a guy who was actually reticent about giving interviews like that. It was a really long interview, and it really played a key role in breaking his relationship with Bernanke. And Honig talked almost entirely about asset bubbles and misallocating resources to the rich at that time. I mean, those were this guy's key concerns. And I think we have a fundamental disagreement about how much, I just can't believe it's not disputed within the Fed that quantitative easing drives up asset prices. That was the whole way the thing was supposed to work, was to drive up asset prices by injecting the money into the accounts of the primary dealers. This is how it works. It benefits Wall Street first. And the hope is that it creates the wealth effect that trickles down to the rest of the population. And that's the part that I think has been very disappointing. But again, they knew it was going to be disappointing. They knew that the gains in unemployment were going to be anemic and small at best, while they were piling up these long-term risks in the market that we are having to confront today. And this talk about the neutral rate, if I could just say one thing, like this old world model that the Fed raises and lowers short-term interest rates to affect the economic growth, to warm or cool the engine, if you will. That model was thrown out the window when Ben Bernanke began his experiment in large-scale asset purchases, in quantitative easing. That changed everything. And that's why rates are almost such a small part of the picture right now, because of the balance sheet expansion, all of this cash that was injected into the Wall Street system that changed everything. And I don't think that it's accurate to say that during the 2010s, there was this phantom neutral rate that the Fed was trying to discover that forced the Fed to engage in these policies of quantitative easing. That was a policy choice that Bernanke made, and that he pushed the Fed governors to follow him with, against their own concerns. It was a policy choice. And so quantitative easing and this injection of the new money into the Wall Street system is different than trying to calibrate the short-term interest rate to meet the neutral interest rate. I think that the talk of the neutral rate doesn't capture the big picture of what they did with the large-scale asset purchases, which really totally changed the dynamics of monetary policy. And I just can't overstate, we are trapped right now. The Fed cannot hike rates without creating a wrenching downward correction in asset prices, which is exactly what started to happen in 2015, but 2018, quantitative tightening and rate hikes really take effect. And I talk about this a lot in the book, and it caused the financial markets to correct downward, like in unison. Bonds, commodities, stocks go downward in late 2018, and Powell backed off because it was too damaging to the financial system.
Guys, let me ask a question, and Peter, when you take it, you can respond if you like to what was just said, but I want to just focus a little bit. Chris, like in terms of what the Fed should do right now, it sort of sounds like, Chris, you sort of think there isn't very little they can do. And you can respond, but let me ask Peter, what do you think the Fed should do right now? And then maybe Chris can take that on.
I think what the Fed is doing is basically what it can do, and I think that making a series of 50 basis point hikes is an extraordinary answer to trying to re-anchor inflationary expectations, and trying to say that we miscalibrated to the extent that this inflationary burst has a heavily monetary aspect to it. This is on us, and we must recalibrate. They're absolutely using the framing, the conventional framing that Chris disputes, that Honig would reject, which says there is a neutral rate in the economy. We don't set it, and now we're trying to figure out where that neutral rate is. And I think that the likelihood of the Fed having a non-recessionary landing, a disinflationary non-recessionary outcome, is extraordinarily small. So here I would differ from the Fed. And the question before I became, I could become convinced that the Fed is the source of these great evils, that they're not part of broader trends and fissures in our economy, broader structures about our politics and our economic structure and our history. I would need to be sure that that paradigm of thinking about monetary policy was so irredeemably flawed for non-ideological reasons that we had to try a different approach. And what I don't understand is what Honig's approach is. How does he know what the appropriate interest rate is? He has never, to my mind, articulated that model, and it's certainly not in Chris's book. And so I think what the Fed is doing is the best that it can do, because if it over tightens, and right now the Fed is making all the right noises, calling Paul Volcker its hero, but we've got to remember that the consequences of the extraordinarily deep 1981 to 1982 recession killed the Rust Belt. Majority minority cities like Gary, Indiana, and Milwaukee and Detroit suffered extraordinary harm because our appetites for taming inflation meant that we were willing to play a very loaded game of dice. That is the view that makes me extremely nervous about hawks left, right, or center, saying we need much less monetary accommodation for whatever consequence. I worry about those families that income, and so in that sense, I worry about a series of 50 basis point hikes that the Fed is undertaking, even though, of course, that is the political and economic climate in which the Fed is operating.
Let me ask you a question then, and I'll let Chris answer to the same question, but you sort of rejected what he said before about the idea that if the Fed had pulled back earlier, it would have more capacity to act now. Why don't you feel that way? I mean, if you're thinking about it, looking at now with like that they're doing 50 basis point rate hikes, and this is a pretty severe reaction that they're in now. Why wouldn't they be in a better position if they had cut the balance sheet more, and in between, it had not done the balance sheet big buildup between 2012 and actually 2010 and 2015? Why isn't that a valid point?
Well, I don't want to say it's invalid. I think this kind of discussion is extraordinarily important. We're being very good citizens by putting the Fed through its paces. So I wouldn't call it invalid. I'm not persuaded by this. So I hope in the tenor of my engagement, Chris, you hear my respect for you in the book, and I think the project is enormously important. So please don't let our debate obscure that truth. The reason I'm not persuaded by this idea that we should have raised interest rates so that we could cut them later, or that we should have raised interest rates so that we could raise them further later. The appropriate question to me is, what is the appropriate level of monetary accommodation or its withdrawal for the economic moment? And the problem that quantitative easing was trying to solve is the problem of zero interest rate policy. Now, Chris in his book talks about a lot of different things under the umbrella of quantitative easing. He talks very well about zero interest rate policy or reserve. And because of the lack of political will and some legal restrictions for the Fed going negative, as Europe has done, as the Bank of Japan has done, and because of legal restrictions on the other kinds of assets the Fed can buy that would be more targeted across the economy, then the Bernanke Fed and the FOMC, although Honig was the only dissenter, there were about 4 others who shared his view, who didn't share his vote. But still the supermajority of the FOMC was with Bernanke. And the problem they were trying to solve is the neutral rate is below us. And so what can we do to accommodate further? And that is why quantitative easing is directly responsive to it. And so I'm uncomfortable with the idea where the neutral rate is substantially below 200 basis points or or 2% or 3%, that we should keep those interest rates high, which is what Honig's recommendation was, even when the economy is screaming out and saying that is not where the return on the productively deployed resources of the macroeconomy is. That, I think, is monetary malpractice. And I think we have to respond to the moment, even though that means that future central bankers might have a different kind of policy scenario that they have to address. Trying to solve the problems of the future at the expense of the present is kind of a perverse form of intergenerational inequity. And it also presumes that we know what the problems and solutions of the future will be. I think what we should expect of our central bankers is try to solve the problems that are before them. And in that sense, I think that the 2020 reaction, it gets pretty high marks. And I think that the bigger question that I think is worth taking up is, what is this system, political, monetary, or otherwise, that we have created in its architecture, and what are its consequences? And I hear Chris asking that kind of question. I think it's a really good one. But I think saying that the Fed, we were doing great, then the Fed did this thing called quantitative easing and everything went to hell. I don't know if that's too much of a caricature of Chris's book. That kind of feels like the argument, and I think that's overstating.
Chris?
My previous book was a profile of Koch Industries, but it was really kind of a history of our economy from 1967 until today. And I guess I'd call it my fiscal policy book, whereas The Lords of Easy Money is a monetary policy book. And in the fiscal policy book, I talk about the death of labor unions, the rise of special interest corporate lobbying, issues of monopoly, a lot of things that have hurt the American economy. But I think you simply cannot understand the dysfunctions of the last decade. Again, this thing I get back to: low productivity growth, wage stagnation, weak economic growth, coupled with just great guns blazing asset markets. That the Fed describes that, and the Fed did that, and it was a policy choice. It was a policy choice. Bernanke made a policy choice, as did his successors. And I'm really glad that I had the chance to report it and to put down in black and white what people said and what they were saying at the time, particularly with the chapter on quantitative easing 3, which was just without question a policy choice to try to drive economic growth forward that was done over the significant reservations of members of the FOMC, and was just broken from the beginning. You saw it. You read the part about Seth Carpenter, the senior economist. Their forecasts were just dead wrong about what it was going to do. The thing grew out of their control immediately. I mean, it's a pretty bleak picture in terms of the policies that the Fed enacted during that period. And I absolutely think it's a good thing for people to read about it, because it helps explain the fragile and dangerous state that we're in right now with these markets. The 2020 bailouts, extraordinary as they were, not just in size, but as you very well know, as you told me when I was reporting this for Time, the Fed was pushing into these new areas of directly purchasing pieces of CLOs, the Main Street Loan Program, which I know never really took off, but the extension of the Fed put into corporate debt markets. I mean, this was an extraordinary thing, and maybe it's not over. We're halfway through this story of what really started in 2020, and the realities of it are becoming more manifest every day. Is my take. And I think it's just almost inarguable that if they had exercised more restraint in 2010, not hiked interest rates, but just shown more restraint, we would be in a much better place today. The Fed would have more ability to maneuver. It wouldn't be a $9 trillion balance sheet, that's for sure. And we'd be better off, no doubt about it.
I have so many doubts. I think that's very arguable, and I'm not persuaded. I think these are important questions. But I think the counterfactual is we would be better off with an unemployment where it was at 9%, at 22% for minority groups. That does not sound like we're well off. Watching the employment rate plunge before 2020 and to 3.4% without accelerating inflation is extraordinary. And look, this is personal for so many people. There are so many families in America who never recovered from the recession of 1981 and 82. There are so many people who did not see the recovery in the post-2008 period until 2019 and 20. The pause in interest rate hikes in 2018 that Chris laments was associated with a continuing drop without accelerating inflation of unemployment to places we had never seen before. And that's a beautiful thing. That's part of a healing, healthy economy. And the idea that we would toss them overboard in the name of this looks bad because the fundamental value of assets is something other than what we're seeing here is hard for me to stomach. Now, that does not mean that I disagree with Chris that the basic architecture of monetary policy that unquestionably favors those whose assets are purchased as a consequence of this execution is the best alternative that we have out there. I'm agnostic on that question. But it does mean even the question that I think Chris is getting at that I think is really important, where I'm not persuaded by his conclusion, but I am persuaded by the importance of the question, is when we target in areas of when we're at the zero lower bound, other parts of the yield curve in the name of expanding monetary accommodation when interest rates, real interest rates are negative and sometimes deeply negative. What are the consequences of doing so? And what are the consequences of not doing so? I think that kind of question is where the hawkish left is both at its strongest in asking and its weakest in answering, because it hasn't made the case, and it's not anywhere in Chris's book, and it's not anywhere in Tom Honig's speeches of what that counterfactual would be for the American working class. And I think that's where folks like me, who are just humble historians, right? So I'm most uncomfortable in these kinds of policy debates with this kind of policy certainty. That's where I think the counterfactual questions, that's where the stakes are highest in this policy debate.
Guys, we're going to wind it down kind of soon. I want to just ask about one more thing that's in the book. It's a quote that you have from Paul Tucker. It's a quote about the role of central banks and the role of other political institutions. And he says, and this is particularly, I'm thinking about this particularly in the context of the United States right now, where there's so much inability to get anything done, as we discussed at the outset of this with guns. The most important constraint is that elected politicians should not be able, in effect, to delegate fiscal policy to the central bank simply because they cannot agree or act themselves. The more central banks can do, the less elected fiscal authority will be incentivized to do, creating a tension with our deepest political values. My question is, do you think the Fed has basically, it's sort of the super economic decision maker, or that's the way it seems. Do you think that's true? And do you think that's a problem for our democracy, that it's doing this because Congress won't do anything?
You want to go first, Peter, or me?
I bet Chris would probably agree on this. I'm not certain of that, but I bet we do. Yes and yes, I think this is a problem. I think that our ability to grapple with hard questions that are either at the periphery of Fed policy, or even at its center that have political content in it even further. It does give me cause for alarm, but I think this is a much harder problem than Paul does. Chris called Paul's book a whistleblower's book. I did not agree with that characterization. I thought it was a mighty academic tome that's raising questions that a lot of central bankers care about. If anything, it's kind of a conventional wisdom about central banking, which is we have got to narrow our scope. We've got to take what constitutes epistemically central banking and be much clearer that it's a narrow set of issues and that the rest belongs to politicians. I think the quantitative easing QE3 arises out of this moment, where Bernanke looks and he sees this fiscal devastation that is being reaped with a game of chicken on the fiscal cliff, and says, if politicians can't react, then we must, consistent with our mandate. And a lot of people, certainly Tom Honig, Chris in his book, see this as wild, aggressive, experimental. I think it's all of those things. QE3 is those things. And the idea that we would just let it burn, it's a hard thing. I don't mean to say that then the right answer is always for the central bank to step up and to solve every problem that politicians can't solve. The moment for political solutions sometimes surprises us, where we pull victory from the jaws of defeat. And the CARES Act in March 2020 is a great example of this. But at the same time, I don't know where the institutional role should be at its best, where the Fed stands up and says, absolutely under no circumstances, politicians, are we going to do anything to help solve the economic problems that your policies created. When they can do so, and that's a very big caveat, that seems to me to be a hard thing to expect of our central bankers, to hold back in policymaking that could accommodate human thriving, to teach the politicians a lesson. At the same time, Tucker's clarion call that their temptation to do so repeatedly, that does have its consequences as well, and has its consequences for our entire political order. Those consequences can be bleak indeed. So I think this is one of the hardest problems of central banking in 2022.
Chris, do you want
to? There's a lot racing through my mind right now. Obviously, it's the United States can't continue to function with this rapidly deteriorating ability of our democratic institutions to operate. It's hugely negative for our entire society. And, we can't rely on, I don't want to say non-democratic institutions, but institutions that were kind of intentionally insulated from the democratic process, the military, the Supreme Court, the Federal Reserve. We can't rely on them to do the work that Congress was meant to do. And if there's, I'm just trying to do a couple things with this book. The first is to give a very easy to understand primer to people about how the Fed works mechanically. It's very important to me how they actually execute quantitative easing, and that the money goes directly into the 24 bank accounts of the primary dealers, and what that does and how that really plays out in the world. And then second, to report on the policies they enacted and the debates within. And so I guess my conclusion is, it seems clear to me we cannot rely on the central bank to drive our economic growth going forward. The model doesn't work very well at all, and it's potentially exhausted at this point. Although who knows, we could be talking about a $25 trillion balance sheet at the Fed in a couple of years or a few years. Who knows?
Okay, guys. Well, look, I want to thank you both for this debate, discussion, debate, whatever we want to call it. It's really actually kind of exciting and kind of in a way very heartening to see people so excited about this topic, and kind of, it's an important topic, and I think it's just great that you guys have thought so much about this, and these issues are so important, and I really appreciate both of you for joining us tonight.